Can a financial giant, famous for credit cards, truly transform into a payments titan and redefine its future? Or will the very consumer champions become, well, its greatest liability? Today, we're digging into Capital One, ticker COF, and we'll look at what our deep dive suggests about its future, especially with its current share price sitting right at the high end of our estimated intrinsic value. Welcome back to the deep dive. This is where we take your sources, articles, research notes, all that stuff, and distill it down into the most important nuggets of knowledge and insight. Think of it as your shortcut to being, well, really well informed. Our mission today: unpack Capital One Financial Corporation. Trades as COF on the NYSE. Our analysis was done as of July 14, 2025, and the closing share price back on July 11th was $219.79. We'll be exploring what makes this company tick, its big strategic moves, and what the numbers are telling us about its potential.
Yeah, and we've got a pretty comprehensive stack of information here. We're laying out everything from Capital One's core business, its market position, leadership, its financials, and importantly, the significant risks and opportunities ahead. We'll basically guide you through 7 distinct chapters to give you the complete picture.
Okay, let's get into it. Let's open the vault on Capital One, starting with the core foundation. Part 1. First up, Chapter 1, Business Analysis. We're diving right into the heart of the matter, Capital One's business model and what truly drives its value.
Right, so Capital One, the what's in your wallet guys. They burst onto the scene back in 1994. And since then, they've quietly become one of America's banking behemoths, based in McLean, Virginia. At its core, Capital One basically runs on 2 main revenue streams. First, there's net interest income.
Right.
That's the classic banking play, right? The difference between interest they earn on loans, think credit cards, auto loans, and what they pay out on deposits. Second is non-interest income. That includes things like interchange fees, the cut they get when you swipe your card, plus other service charges.
But the really big news, the pivotal shift, is this pending acquisition of Discover Financial Services, isn't it?
Oh, absolutely. This is huge. And it's not just about Capital One getting bigger, scale for scale's sake. It's about fundamentally changing who they are. They're moving from being a company that just uses the payment networks like Visa and MasterCard to basically owning a payments network through Discover that lets them capture those lucrative processing fees themselves, moving towards a closed-loop system.
Oh, like American Express.
Exactly, like Amex, but aimed at a much broader audience. It could really alter their long-term earnings power. It's a massive strategic pivot.
Okay, so a deep transformation indeed. What about their bread and butter? Their core products and market position today?
Right, their offerings are pretty broad. The credit card segment, still the flagship. It's their biggest profit center, historically over 60% of profits. We're talking like $156.7 billion in credit card loans as of Q3 2024. Huge numbers. They've got a whole suite of card products. Then there's consumer banking. That's your everyday stuff, deposit accounts, but also a major player in auto finance. That's another big portfolio, around $75.5 billion in auto loans. And finally, they have commercial banking, serving businesses with lending, treasury management, things like that. Scale-wise, they're already formidable. 9th largest U.S. bank by assets, about $475.6 billion at the end of 2023. They were the 3rd largest issuer of Visa and MasterCard credit cards by loan balance at the end of 2024. 4th largest overall.
And the Discover deal.
Yeah, the Discover impact. The combined company would likely be the largest U.S. credit card lender by total loan balance. We're talking maybe 22-24% market share. Globally, they were already a major competitor, holding around 4.6% share in 2024. Discover just solidifies that. Plus, they're a leader in U.S. auto loans, too.
That's a massive footprint.
Okay.
So what's their unique angle, their primary value proposition?
Okay, their primary value prop is really this technology-driven approach and customer-centric innovation.
Wow.
Since day one, Capital One's been about data analytics. They call it their information-based strategy, or IBS. It's not just buzzwords. It's this constant process of testing like tens of thousands of mini experiments.
Tens of thousands.
Yeah, it's almost like a science lab inside a bank. They A/B test everything, offers risk assessment to find profitable niches others might overlook. That's been their secret sauce. And now imagine plugging Discover's direct transaction data into that engine.
Wow. Okay.
They serve over 100 million customers. Things like Capital One Travel, which tries to predict flight prices. That shows their focus on solving customer pain points using data. It's a core differentiator.
And looking at the wider industry picture, what are the big trends affecting them? How do they stack up against rivals and the regulators?
Well, the whole financial services industry is moving incredibly fast, right? You've got digital banks, AI, embedded finance. It's reshaping everything.
Huh.
The good news for Capital One is the outlook for their core markets. U.S. credit cards, global auto finance is positive growth, projected 9.5% CAGR for cards, 11.4% for auto finance. And Capital One's actually really well positioned because they invested in tech early. They were the first major U.S. bank fully on the public cloud.
That gives them an edge with AI and stuff.
Exactly. A big advantage for deploying AI. And that Discover deal, it's a direct play into embedded finance and banking as a service, or BOSS, basically letting other companies plug Capital One's banking functions into their own apps. Now, competition is fierce, no doubt about it. They're up against the traditional giants, JP Morgan Chase, Bank of America. Also, specialized players like Amex, Ally Financial, and all those nimble fintech startups. The U.S. credit card market is concentrated. Top 10 issuers have like 83% of it. And with Discover, Capital One goes head-to-head with Visa and MasterCard on the network side. That's a whole new ballgame.
Those regulatory hurdles you mentioned sound like a pretty high wall for anyone new trying to get in.
Oh, absolutely. The regulatory environment is incredibly complex, costly. You've got the Fed, OCC, FDIC, CFPB watching everything. Legislation like Dodd-Frank, Basel III, it's a maze. And there's this constant push-pull, right? Potential deregulation talk on one side, but then heightened scrutiny on the other, like the CFPB on late fees or that proposed Credit Card Competition Act.
So it cuts both ways.
Exactly. It's a huge barrier for new competitors, which helps Capital One, but it also means massive compliance costs, and new rules could directly impact how the Discover network operates. And beyond regulation, the other barriers are just formidable. Massive capital requirements, the regulations themselves, meeting huge economies of scale for marketing, tech. But the really crucial one for payments is the network effect, the two-sided network effect.
Explain that a bit.
Okay, think of it like a dating app or an online marketplace. It only works if you have lots of buyers and lots of sellers, right? For payments, you need tons of consumers with the card and tons of merchants accepting the card. It's hard to build from scratch. Discover already built that network. Capital One is essentially buying its way past that massive barrier.
So their competitive advantage isn't just being big then?
Not at all. Their brand is huge. Everyone knows what's in your wallet. Hurrah! High customer satisfaction for decades helps too. Scale gives cost advantages, sure. And being first to the cloud gives flexibility, maybe lower long-term costs. But the Discover deal significantly strengthens their moat because it creates that powerful two-sided network effect we talked about. Still, their most unique asset, I'd argue, is that information-based strategy, that IBS. It's the engine that let them serve overlooked segments profitably. And the potential synergy of IBS with Discover's network data, actual transaction-level data from millions of merchants, that's probably the single most important aspect of the merger. It could unlock hyper-personalized marketing, totally new products, much smarter risk models. That could be a truly durable competitive advantage.
Okay, we've looked at the strategy, the market, that huge Discover bet. But who's actually making the decisions here? How good is the leadership? Let's turn to Chapter 2, Management Evaluation.
Well, one interesting thing is Capital One is still founder-led. Richard Fairbank has been chairman and CEO since the IPO in 1994. That's over 30 years.
Wow, that's rare.
It provides incredible continuity. He co-created that IBS concept. He navigated the 2008 crisis, the COVID pandemic. Remember, they suspended buybacks then to keep capital strong. And he's the one who transformed them from just a credit card company into this diversified bank through acquisitions like Hibernia, ING Direct. His whole career seems defined by this vision for tech and data, and Discover really feels like the culmination of that.
How about transparency and any skeletons in the closet, ethically speaking?
They're generally seen as having high transparency in their financial reporting. Standard SEC filings are detailed. But like most big financial institutions, they haven't been immune to challenges. There have been consumer class action suits, fines related to anti-money laundering programs in the past, even SEC charges against former analysts for insider trading back in 2015. It kind of comes with the territory when you handle so much sensitive data in such a regulated industry. It highlights the risks. In terms of capital allocation, their strategy's been pretty consistent. Grow the core lending businesses and acquire tech or capabilities. They reinvest a lot in marketing and tech. And their M&A has been bold. ING Direct was big, but this Discover deal at $35.3 billion, that's the biggest by far.
A real bet the farm move.
You could definitely call it that. It's all about becoming vertically integrated. They also do smaller tech acquisitions like design firms to tuck in new capabilities.
And how do they handle returning money to shareholders? Dividends, buybacks versus that big spending on Discover?
They seem pretty pragmatic. The dividend history is long and stable, paid every single quarter since the 95 IPO. Current dividend is $0.60 a share per quarter, $2.40 a year. They did cut it briefly during the pandemic uncertainty in 2020, but quickly restored and increased it. The payout ratio is really conservative, like 20-24%. That means the dividend is very safe and leaves plenty of cash for reinvestment.
And buybacks.
Historically, they've used them quite a bit, like $5 billion back in early 2022. But lately, they've pulled back only about $246 million in the last year or so, clearly conserving capital for the Discover deal. Ultimately, the real test of their capital allocation skill is return on invested capital, ROIC. It was 5.72% for 2023, ticked up to 7.1% TTM in early 2025, but then dipped to 4.28% in Q1 2025.
So it bounces around.
Yeah, it's naturally cyclical for a lender tied to the credit cycle. The big question, the ultimate test for the Discover deal, is can it generate a higher, more stable ROIC that's well above their cost of capital? That's what justifies the huge price tag. Investors really need to watch that ROIC post-merger.
All right, we've assessed the leadership and your grand strategy. But strategies only work if the finances stack up. Let's dig into the numbers, the balance sheet, the income statement. What's the real story of Capital One's financial health? Time for Chapter 3, Financial Analysis.
Okay, the numbers. As of July 2025, their market cap is around $100.6 billion, so a major global player. Revenue growth. Pretty strong over the last 5 years. Annual revenue went from about $33.8 billion in 2019 up to nearly $54 billion in 2024.
Nice growth rate.
Yeah, that's a compound annual growth rate of almost 10%, mostly driven by loan growth, cards, and auto, and also helped by expanding net interest margin.
What about profit margins? How efficient are they?
Okay, for banks, net interest margin, NIM, is key. And Capital One's NIM expanded quite a bit, hitting almost 7% in 2024, even higher in Q4. That's thanks to higher interest rates. Their operating margin trailing 12 months is around 15.25%, net margin about 13.25%. But these margins have been volatile. Higher rates boost NM, which is good, but they also usually lead to higher provisions for potential credit losses, which then squeezes the operating and net margins.
Right, that double-edged sword idea again.
Exactly. Now, free cash flow, FCF. Capital One is a strong, consistent generator here. Over $16 billion annually in recent years. And that robust FCF is crucial. It's what pays the dividend, funds buybacks when they do them, and critically, it's helping pay for that massive Discover acquisition.
How consistent have earnings been? And how stable does the balance sheet look?
Earnings per share, EPS, definitely follows a cyclical pattern. That's pretty typical for a consumer lender. Like, EPS was around $7 back in 2015. Then it spiked like crazy to nearly $27 in 2021.
Whoa, what happened there?
That was mostly an accounting thing, really. During the pandemic, banks set aside huge amounts for expected loan losses that didn't fully materialize. When they released those reserves back into earnings, it artificially boosted profits massively in 2021. So that $27 was an anomaly. EPS then normalized back down to around $11.60 in 2024. Their real sustainable earning power is much more tied to the economy.
Got it. Makes sense.
Balance sheet stability looks good. Their debt-to-equity ratio was 0.65 as of March 31st, 2025. That's conservative, below the industry average, gives them flexibility. The current ratio is around 0.98, which is normal for a bank. Investors should focus more on their regulatory capital ratios like CET1 and their liquidity coverage ratio, LCR, which are strong. And the dividend, as we mentioned, is strong and consistent, paid every quarter since 95, grown steadily. Current yield around 1.1%. And that super low payout ratio, just over 20%, means it's very safe and leaves tons of room for reinvestment.
Okay, let's pivot to valuation. How does Capital One look compared to its peers, its own history? Is it expensive, cheap, somewhere in between?
Right now, its price to earnings, or PE, ratio is 18.54. That's as of July 10th, 2025. Now, historically, that's a pretty significant premium. Its 10-year average PE is only 11.18, so it's trading much closer to its historical peak valuation levels.
How about compared to other big banks?
Also at a premium, peers like JP Morgan Chase are around 14, Bank of America around 13.8, Citi 13.5, Wells Fargo 14.7. So yeah, COF is trading noticeably higher. What that suggests is the market has really high expectations baked in. Expectations for future growth, especially from Discover, turning them into a higher multiple integrated payments kind of company. Beyond just PE, we also looked at intrinsic value using a discounted cash flow, or DCF, model.
Remind us what that is.
Basically, the idea is a company's value today is the sum of all the cash it's expected to generate in the future, discounted back to the present value. Our educational DCF model for Capital One suggests an intrinsic value range of $185 to $235 per share. But, and this is important, it's just an educational model. It's highly sensitive to the inputs. Things like the long-term growth rate we use 3% to 5%, higher end reflects Discover hopes in the discount rate, or WACC, which reflects risk we used 8% to 10%. Small changes there can really swing the valuation.
All right, part one covered the business, the management, the financials. Now for part two. This is where it gets really interesting, I think. How is the market actually viewing Capital One? Who owns it? And what are those critical risks and opportunities that could really define its future? Let's start with Chapter 4, Market Sentiment. How's Wall Street feeling about CO right now?
Generally, Wall Street sentiment is broadly positive. The consensus rating from analysts is usually a moderate buy or outperform. The average 12-month price target is somewhere between $233 and $239, so suggesting some modest upside from the current price. But there's a really wide range in those targets. Highs up around $264, lows down near $169 or $90.
That spread reflects the Discover uncertainty.
Exactly. It shows analysts have pretty different views on how well that integration will go and what the payoff will be. But the fact that many are raising targets lately suggests they're generally buying into the merger story. News coverage. It's almost all about Discover. Headlines like game-changing profit venture or asking, does 1 + 1 = 3? You also see updates on consumer health, regulatory stuff. The overall tone, I'd call it cautious optimism, balancing that huge potential with the very real execution risks. Market indicators look pretty positive, too. Short interest is low, only about 2.1% of the float. That's way below peers, suggesting bears aren't really targeting the stock heavily. And it's been decreasing. Technically, the stock's showing strength. The current price of $219.79 is trading nicely above its 50-day moving average, which is a bullish short-term signal, and it's significantly above its 200-day moving average, which points to a strong, bullish long-term trend.
Okay, so sentiment seems generally positive, if cautious. Who's actually holding the stock? Who are the major players? Let's look at Chapter 5. Ownership structure.
Yeah, ownership is heavily tilted towards institutions. They hold about 95.4% of the shares. It's very concentrated. The top 25 shareholders own over 60% of the company.
Wow. Who are the biggest names?
The usual suspects, really. Vanguard is the largest at 8.42%, then BlackRock at 7.36%, State Street at 4.44%, Dodge & Cox at 4.25%. This heavy institutional ownership generally points to a stable long-term shareholder base. These big firms tend to support strategic vision. They aren't usually short-term traders. Insider ownership is relatively low, around 1.3%, but the key figure there is founder CEO Richard Fairbank. He owns 1.11% himself.
That's still a huge stake, dollar-wise.
Oh yeah, nearly $890 million worth. That definitely creates strong alignment between him and other shareholders. His interests are tied to the stock price. You might see recent acquisition transactions listed for executives, but those in June 2025 look like standard vesting of stock awards, not new open market buying. The lack of significant open market selling by insiders is generally seen as a positive sign. That high concentration, though, with institutions owning 95% and the top four controlling over a quarter, it means stability, but also that the stock can be heavily influenced by decisions from just a few big portfolio managers.
Okay, every investment story has two sides. What could go wrong? What could go right? Let's map it out with a SWOT analysis in Chapter 6, Risk Assessment.
Right. Let's start with the strengths. We've touched on these. That data-driven culture, the IBS, their tech leadership with the cloud migration. That's core. Their brand and market scale are huge assets. Household name, high satisfaction, top-tier positions in cards and auto, over 100 million customers. And having founder-led management with Fairbank's long-term view, plus a strong, conservatively run balance sheet, those are definite pluses. Now the weaknesses. The big one is their exposure to credit cycles. They have a significant chunk of subprime and near-prime customers.
Meaning they're more vulnerable in a downturn.
Exactly. Earnings become more cyclical, loan losses can rise more sharply if the economy sours. Then there's the massive integration risk with Discover. It's their biggest, most complex deal ever. If they stumble executing that, the hoped-for synergies could be delayed or even evaporate. And some analysts point to a potentially centralized decision-making structure. While that ensures consistency, it might perhaps slow things down or stifle innovation from lower down.
But the flip side must be significant opportunities, especially with Discover.
Oh, absolutely. The opportunities are potentially enormous. Discover network synergies are number one. Vertical integration means new, high-margin revenue streams. Plus, that proprietary transaction data feeding the IBS engine, that's the holy grail for creating innovative products, hyper-personalized marketing, better risk models. Their cloud infrastructure positions them well for AI, leadership underwriting, fraud, customer service. Discover also lets them be a key player in bus and embedded finance. And don't forget, their core markets cards and auto finance are still projected to grow over the long term. But then you have the threats. Competition isn't going away. It's intense and always evolving. Big banks, specialists, fintechs. Regulatory scrutiny is constant. Pressure on fees, interchange rates like the potential Credit Card Competition Act, capital requirements. It's always there. And cybersecurity is a huge risk for any big bank, plus broader geopolitical instability. Looking specifically at macro factors, high interest rates are that double-edged sword. They boost NIM, yes, but combined with inflation, they really strain household budgets.
And people are already carrying a lot of credit card debt.
Right. U.S. credit card debt is at multi-decade highs. If we hit a real economic downturn with rising unemployment, that debt could become unserviceable for many. As one CEO put it, if we have a downturn, we might have more stress than people expect. Capital One's consumer focus makes it particularly vulnerable to higher loan losses then. And one specific geopolitical threat worth noting, those potential U.S.-imposed tariffs discussed for 2025.
How would that hit Capital One?
Directly and materially. Tariffs generally increase consumer prices. One Yale estimate suggested a 2.1% increase, hitting real income. Auto prices could jump significantly, too. That reduces purchasing power, slows the economy, could lead to higher unemployment. This directly impacts Capital One's core customer base, middle income, subprime folks, making it harder for them to pay their debts. Financial stocks have historically reacted badly to tariff news, so the risk is higher delinquencies and charge-offs for Capital One if those tariffs bite hard.
Okay, we've covered a lot of ground. Strength, weaknesses, huge opportunities, significant threats. Let's try to bring it all together. Chapter 7. Conclusion. What's the final take?
All right, synthesizing it all. The bull case really hangs on that visionary, founder-led management team, their long-term focus on tech and data, that powerful IBS, plus the strong brand dominant market position, and most importantly, that potentially transformative Discover acquisition. It's a strategic pivot to vertical integration that could enhance their moat, unlock new revenue, and give them incredible data advantages. The bear case. It boils down to valuation and risk. The stock's trading at a hefty premium, implying the market expects near-perfect execution of the very complex Discover merger and continued strong growth.
But the risks are real.
Exactly. You've got heightened macroeconomic risk, high rates, the potential drag from tariffs really squeezing their core consumer base. If there's a significant downturn, loan losses could spike, hitting earnings hard and likely compressing that high valuation multiple the stock currently enjoys. So to restate the valuation summary from our educational DCF model, we estimated an intrinsic value range of $185 to $235 per share. Again, emphasizing it's an estimate, very sensitive to assumptions, which leads to our concluding outlook, basically neutral. Capital One's current share price, around $219.79, is sitting right near the high end of that estimated intrinsic value range. What that suggests is the market has already priced in a lot of future success and growth. That leaves potentially less margin of safety for investors right now, especially if that massive Discover integration hits bumps, or if those macroeconomic risks, particularly consumer stress, perhaps amplified by tariffs, turn out worse than currently expected.
This deep dive into Capital One really does highlight that tension, doesn't it, between this ambitious strategic vision and the tricky realities of a credit-sensitive economy. As Capital One tries to become this payments titan, the big question maybe for you, the listener, to ponder is, how much more can the U.S. consumer actually bear? And how will that ultimately shape Capital One's long-term path? Thank you for joining us on this deep dive. If you found this valuable, want to stay well-informed, you know what to do, like and subscribe to the Stock Analytics AI YouTube channel. Our members, it's just $4.99 a month, get priority deep dives on tickers. And over the next few months, we're covering all of the S&P 500 stocks with exclusive priority access for members first. And hey, if you want a one-off deep dive on a specific stock that's caught your eye, just drop us a super pen. Thanks. We appreciate the support.
And please remember, this analysis was generated by an AI system. It's for educational purposes only. It should definitely not be considered financial advice. Always do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions. Thanks for listening.